Hi everyone, this is Matt Curfman here with Richmond Brothers on Leap Day, which is February 29th of 2020 for a weekend edition of Matt's Minutes for closing out the month of February. Well, it was certainly a rough week in the markets. Many of you saw my video I sent out Tuesday night and we posted in your portals on Wednesday morning, and I appreciate the feedback in the comments so that we can keep providing you more up-to-date information and accurate information. So the last video, which was Tuesday the 25th, I had mentioned it was kind of the topic of market jitters, the coronavirus. The markets were swinging quite rapidly this week. At the time, the markets were off around 5 to 6%. And we did end the week in negative territory. And actually, I mentioned that we could hit a correction. And a correction is defined as the market coming down 10% from its highs. And all three broad index, the Dow Jones, the S&P 500, and the NASDAQ, did end up closing the week in correction territory. So we have come down 10% from our highs. So I wanted to give you a little bit of data and some information as you get ready for the month of March and we move forward and continue moving forward into the new year. So the week that just ended, February 28th, that was actually the worst week in the markets, believe it or not, since the 2008 financial crisis. In just the last week, the Dow Jones was down 12.3%, the S&P 500 was down 11.4%, and the NASDAQ was down 10.5%. Remember I said that a correction is 10% off of your highs, so if I went to the very peak of each of those index measures this year, the Dow is 14% off of its high. The S&P and the NASDAQ are both 12.7% off of their high. So that is where we technically have hit a correction. Now, year to date, if we go back to January 1st until February 28th, the first 2 months of the year, the Dow is down 10.9%, the S&P is down 8.5%, and the NASDAQ is down 4.5%. So certainly in negative territory. So again, if you kind of think of your whole portfolio as a pie, and you look at that pie chart, not 100% of that money is traditionally going to be in the market. And so that's why you have these other slices of the pie. Because when the markets act like this, for reasons whether we agree or believe with them, it still happens. It's good to basically have that balance. And so if you go back in history at market corrections, I went back since all the way back to World War II. And since World War II, prior to this past week, we've had 26 market corrections, where on average the market decline was about 13.7%. So when we just looked at the off highs, the Dow is off 14, the S&P and the NASDAQ are off 12.7. So we're not terribly far off of that historic average. Now, that doesn't mean that we couldn't go further down temporarily, but it does at least give you some historical context. No matter what was going on in the environment, the average market correction was 13.7%. And then if you look at those 26 corrections in time going back to World War II, the average time it took to recover out of that correction, meaning the market came back up and returned to a growth mode, was about 4 months. So again, negative 13.7% average, it's almost where we're at right now, and then a recovery on average of 4 months. The question is this a correction and only a correction? And so what you're starting to see is corporations across the globe are starting to issue revenue and earnings guidance kind of warnings, because they had set projections at the end of the year going into this year. And so what's happening is there's still a little bit of unknown out there. You know, for example, contaminated areas, China, for example, is a big part of the supply chain. And so warehouses and distribution, and if people are told to stay home and not go to work to prevent further spread of the disease, that can have a global disruption on certainly products and services. Now, does that mean it's a forever interruption, or is it just temporary? And obviously, there are very smart people and scientists all across the globe working on the coronavirus and its implications. So I wanted to kind of put this out there again, remind you that you're going to, in the next few days, Fidelity is going to send you notifications that your monthly statements are ready. early next week through all of your portals. If you're a client of ours, you will have your monthly snapshots. Now remember, your monthly snapshot includes everything you own, including the bonds, including the fixed annuities, and some other asset classes where you do have downside protection. So make sure you kind of look at your aggregate picture. And while it's not perfect, and while we are certainly not perfect, we're not completely immune from what's going on. But I do think having a lot of that balance has greatly helped mitigate that downside. And I think most of us will find that we're nowhere near to the extreme down what I just shared that the markets are. So again, this is why a few weeks ago, and I mentioned this February 25th, things seemed pretty rosy in the markets, and they were so rosy, in fact, that we thought, well, it's probably near the top of a hill. We would have never guessed that this would have happened so quickly and so fast, but that is one of the reasons why we wanted to skim off the top of holdings, for example, such as QQQ, the S&P 500 index fund. And so again, you want to skim when times are good, and it's hard emotionally to skim when things are good and go to something that's stable. And you want to just keep with the growth stuff. Well, the growth stuff doesn't always grow. So just kind of keep that in mind. So a few other points, and I'll let you get on with your weekend. Some action items. People are saying, should I start buying? And this is a really hard thing to answer. It depends on your own individual risk tolerance. There's certainly an argument out there that says if you start buying like this past week, you would have literally been catching a falling knife and you would have still gotten bloody because you would have been buying on the way down, but yet we weren't done going down yet. So time will tell. I would always answer that question with a measured approach. If you don't mind buying and realizing you couldn't be at the bottom, or the market might not be at the bottom, I think that's something just to be aware of. Other thing I mentioned is IRA to Roth conversions. I still think that is a profound strategy, and all of us at Richmond Brothers can help guide you on that. But again, if you had a $10,000 stock investment that now is worth $8,000 and you were going to hold it anyways, and it's in an IRA, anyone in any circumstance can take IRA funds and convert to a Roth. Now, when you convert, that's a taxable event to you. But then once that $8,000 investment is in a Roth, if over the next 5 years that $8,000 recovers back to 10 and then grows to 11 or 12, now that entire investment is in an account that truly is forever tax-free to you. There's a few rules that go with that, but we're certainly well-versed and can help you if you individually have that question. So it's a challenging time to think about converting when portfolios are down a little bit, and also, suggesting that you choose to pay a little more tax, but it's a great opportunity to take advantage of. If any of you are watching this and are still working and contributing into 401ks, 403bs, I would not let this concern you about contributing, about company match. In fact, I almost might as go as far to suggest as make sure you keep contributing, because the benefit of while you're working is your dollar cost averaging every paycheck into this volatile market. If you're retired, and a lot of you are who are our clients, and you're drawing income, just again, a reminder of why we want to look to your money markets first, why we want to have, whenever possible, a forward 3, 6, 9, 12, even 24 months of income, kind of sitting in liquid, low duration, stable assets, so that we're not in a position right now where if you were drawing income, you would have to sell stock at a low price to fund your draw. Usually that's a downward spiral that's hard to get out of. So just wanted to remind you of that. This is also a great time as you have your next review, phone conference, video conference meeting with any of us through Richmond Brothers. A good time to review Riskalyze and your Riskalyze number, if you remember the scale of 1 to 99. So we can kind of gauge that against your portfolio. And lastly, I would just make sure with respect to the coronavirus, there's a lot of news, there's a lot of media coverage. I would suspect that also lends itself to a lot of misinformation. So make sure you're going to trusted sources. Consider, for example, the cdc.gov website, and watch for travel warnings and things of that nature. I'll close this month, of course, letting you know that we're here for you. We are paying attention. We are doing all the research we can to see if we need to act further. So far, it looks like at least the futures markets going into next week have turned somewhat positive, but again, time will tell as we begin the 1st of March. But it is a leap year, and what is the leap year? Basically, it's a reset, syncing of the calendar, because a year is technically a little more than 365 days. So every 4 years, we have a leap year to adjust the calendar. And so let's all use this weekend to kind of reset our minds on this. Respond in a calm manner, and please feel free to call, email, ask us questions. Best way to get us is questions@richmondbrothers.com. If you have any questions about your specific situation, we're happy to talk. Thank you so much for tuning in. I know this video was a little longer. Enjoy your weekends, and for those of us here in Jackson and in the Midwest, it's still a little chilly, but it is sunny and beautiful out, and it's supposed to start getting into the 40s and 50s tomorrow. So not quite like all of you down in Florida, but we're certainly happy. And as I sign off, I thought I would just show you one of our little guests here waiting in the room to get out. Thank you for tuning in. Thank you for being part of the Richmond Brothers family. We're here for you, and we're honored to be here to serve you. Thank you.